Do you still think there's an opportunity to build a brand at the pre-seed stage before the accelerators or simultaneous with accelerators?
Accelerators exist to give advice on how to start a company at scale. The accelerator round isn't really there because they're giving you the capital. They're not giving you that much, but they're giving you important know-how, how to put your company together, how to recruit, how to rev your idea, when is it ready for investors, how to get your MVP out there, how to measure customer growth, how to approach the first customers and all of that. The training wheels until you're ready to go raise money. And the truth is, an angel investor can do this. They just have to put in the time. And I actually think this is the best place to play because the valuations at the so-called seed ranges are where A round used to be. If you want good valuations and the best deal flow, the best way is to create it yourself by allying with entrepreneurs early on, becoming their shadow business co-founder. Technical entrepreneurs today, builders, when they start out, they often have to give up half or 2/3 of their company to a seller to put the company together for them and raise the money. You can be that shadow partner. You could help them put the company together. You could put in the first little bit of money. You might even be able to get common equity in addition to your investment or favorable investment terms. And then you can help them recruit the seller later on for 5 or 10% of the company as opposed to 50% of the company.
If you're investing at the pre-seed stage, you can back great teams, you can set the terms that you want, and you can get pro-rata rights.
Pro-rata rights are the ability to invest in later rounds. Let's say that you own 5% of a company through your original investment. That means every round they raise in the future, your pro-rata right would give you the right to invest another 5% of that round. Even though you already owned a lot to begin with, and you may not care as much about the dilution, the cash-on-cash returns for the later investments tend to be much better because the amount of money you can put in might be $30 million instead of $3,000. Once the company is more proven, limited partners and big funds will fight for pro-rata rounds and pay you carry and pay you management fees to invest that pro-rata for them. And you're not waiting 10 years for liquidity. The later rounds, it might only be 2 years away from liquidity. So pro-rata can be quite valuable. It also keeps you more plugged into the company. You keep a closer relationship with the management team. They have to let you know what's going on. And if there's a down round or a washout round, it lets you have more senior stock that can at least protect some of your holdings in a wipeout scenario.